This is Matt Godleski with Cap Trust Advisors, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks drop as headwinds emerge, as bond yields remain lower on growth concerns and economic data softens. The bull market took a breather this week as the COVID Delta variant spread and Federal Reserve signaling sent risk sentiment lower. Oil, commodities, and assets most tied to the economic reopening slumped. Emerging markets have wiped out their gains for the year while the dollar rose in value. The spike in virus cases is leading to renewed mask mandates and localized capacity restraints, while also creating concerns that supply chain disruptions could return. Adding to the souring mood, the return of the Taliban in Afghanistan creates an additional risk on the horizon. A further crackdown from heavy-handed authorities in China has continued to plague risk assets there, hitting emerging market stocks hard. Finally, the Federal Reserve indicated from their July minutes that they are preparing to begin reducing their monthly bond purchases. Fears of a taper tantrum, referring to a violent market reaction to reduced Fed support, are overblown in our opinion. On a positive note, U.S. employment appears to be improving. Hiring has picked up and unemployment claims are at new pandemic low. Open positions abound, though hesitancy to return to work for many leaves businesses understaffed and the economy slow to rebound. We are continuing to evolve portfolios to the risks and opportunities we see in today's markets. The economic transition from a powerful rebound to a slower growth world requires a rethink of positioning. We remain overweight equities, though we have reduced the overweight to rebalance portfolios back closer to their target risk allocation. Despite headline risks from the Delta variant, we believe economic growth will remain strong. Though global stocks likely will find it challenging to keep up the pace of growth since March of last year, a strong U.S. consumer and labor market, a still accommodative Federal Reserve, and ongoing fiscal stimulus should power stocks higher. Our preference for more economically sensitive stocks remains high, while we also maintain an emphasis on long-term opportunities within technology and healthcare sectors. Bonds present unique challenges at this time, with the risk of rising real interest rates likely leading to declines in values for benchmark indices. Sustained higher inflation creates another potential headache for this asset class. Despite the threat of rising rates, fixed income assets still serve a significant purpose in portfolios in dampening volatility and providing principal protection during future market routes. Value still remains in certain segments of the bond market, though upside is limited in our view. Internationally, ongoing regulatory uncertainty in China also leads us to be cautionary on exposure, despite the significant innovative opportunities incubating there. Europe, meanwhile, should continue in the footsteps of the U.S. as the vaccine rollout gathers pace and economic growth firms from the more severe restrictions faced in the past several quarters. As always, we remain focused on unfolding market dynamics and make changes only when appropriate. Thanks for watching.